Welcome to MFX Center's 2-Minute Trading School, where 2 minutes a week can change your trading life. Before progressing further, let's look at the disclaimer. In this video, we'll be talking about the best moving average settings that a trader can use. Moving average is generally an average of price which can be used as a dynamic level support and resistance and also for understanding the market trend. There are certain things about moving average that most of the traders don't know. So in this video, we'll be covering the most effective moving average settings that a trader can use to understand the market well and make consistent profit from the markets. So let's look at the chart for more explanation. In this chart, we see two exponential moving averages that I personally use to understand the market. The closest one is the 20 exponential moving average, which is colored as golden, and the far one is 200 exponential moving average, which is colored as green. Now, what I use the moving average is for understanding the market and getting the dynamic support and resistance levels, as well as sometimes I use them for a trend change crossover. What is a trend change crossover? I'll be covering it later on in this video, but first let me introduce you to the dynamic support and resistance. So support and resistance, we know is support is when there is a level below the price, and resistance is when there is a level above the price. Okay, but when there is not any static level but a dynamic level above or below the price, that is where the dynamic support and resistance comes in. And if you are looking forward to buy or sell on the basis of dynamic support and resistance, these two set of exponential moving average will be helping you to understand the long-term and short-term view of the market. So the first one, that is the golden one, what I use is 20 period moving average, and the moving average method is exponential, which is applied to close, and you can choose any color you want. Then the longer term that I use is 200 period moving average with the moving average method of exponential. You can also use it as a linear weighted, but I use exponential. And you can choose any color, style, or you can just make the line a bit fat or thin on the basis of your judgment or your perception, whatever you want. But the main thing is that whenever the price is above these moving averages, that means it is in a buy momentum, and whenever the price is below this moving average, then there are sell momentum. But how we can use it as a dynamic support and resistance? That is pretty easy. First of all, we need to watch the market and see whether the moving average was broken above or below. In this case, we see the moving average was broken above, and then it retested the long-term EMS, that is 200 exponential moving average. And after the bounce off, you can buy from here, and you can pyramid your trade on the basis of the retracement or rejection of the 20 exponential moving average. So first you need to have the long-term perspective, then you go into the intraday perspective. So for an example, if you go a bit before that, whenever the price broke below this 200 exponential moving average, it retested. This kind of retest is called mean reversion. Actually, there is a explanation for that, because whenever the price is going away from the average, after sometimes it will always come back to its mean, the mean price. So for that reason, as we get the moving average, that is 200 or even 20, the price will be moving towards that moving average to find a resistance or support, or to find a level, or to find a seller or buyer to continue the trend. It is that easy. So in this case, the price broke below this long-term moving average, and then it retested the long-term moving average again as a resistance, and then it continued its trend. Same here. When the price moved above this long-term moving average, it retested the long-term moving average again as support, and then it continued its trend. But in the meantime, when there were a certain amount of small pullbacks, it were retested and rejected and found support from 20 exponential moving average. So for the long-term perspective, it is very important that you get to know the 200 exponential moving average, and then for the short-term perspective, you need 20 exponential moving average. There are some times when the price will be breaking below or above the 200 exponential moving average and it will not retest. In that case, you should have to understand that there are an impulsive momentum in the market, and you should look for any kind of pullback towards 20 exponential moving average. And the last one but not the least is the crossover. Sometimes whenever you see there is a crossover of 20 and 200 exponential moving average, then you should understand that the trend is going to switch, but there could be some times that it doesn't mean anything. So for an example, if the price has broken below this long term and the 20 exponential moving average, this is the closest of the price, also moves below this long-term moving average, that means there was a crossover right in this area. So after the crossover, it does indicate us that there is a strong selling pressure going on, and we will be looking forward for a retest to get into the trend. Same as here, there was a kind of a crossover over here, and then the price moved higher. After a certain pullback, we got into the trade. Then if you go into a certain period when there was a big amount of range over here, if you just see, it was a kind of a squeeze, and in this squeeze there were numerous times of crossovers which failed. So you should understand that sometimes this crossover can fail, but you should make sure that the long-term moving average, that is the 200 exponential moving average, has been found as a resistance and support, and it can work as a miracle sometimes. So after the breaking of this squeeze, the price found support at 200 exponential moving average, and then it pushed higher, and the risk reward ratio were pretty much impressive, because with around 30 pips or 35 pips of a stop loss, you were getting around 500 pips. So that is a big risk reward ratio that a trader can get, right? So these are the two things how you can use the moving averages in your trading, and how you can also understand the market well. For knowing more about more trading techniques and understanding the market, please subscribe to our MFX Center channel, and also let me know what kind of video you are looking forward from MFX Center, and if you are interested in any kind of strategies that you need an explanation. So just like the video if you liked my presentation and liked the lesson, and please subscribe to our channel and click on the bell icon for getting notification from our channel's latest publications. Thank you for being with me. Thank you for being with MFX. See you soon next week.